Right now, Nokia stock, trading under the symbol NOK on the New York Stock Exchange, is sitting around $3.45 per share, showing a slight decline of about 0.8% during today's trading session on volume that is tracking just below its 30-day average. But if you think this muted price action means Nokia is just another forgotten telecom legacy play drifting sideways, you are missing the massive tug-of-war happening behind the scenes between institutional expectations and structural reality. Most retail investors looking at their Robinhood stock trading app or browsing Fidelity Investments see Nokia as a relics manufacturer from the flip phone era that tried and failed to pivot to smartphones and is now limping along as a distant third-place network equipment vendor behind Huawei and Ericsson. The common narrative is that the global 5G rollout cycle is largely over, telecom capital expenditure is drying up globally, and traditional carriers are cutting budgets to protect their own cash flows. People assume Nokia is stuck in a low-growth, low-margin trap with nowhere to go. That consensus belief is fundamentally incomplete. What the broader market is failing to price in right now is a massive internal shift in where Nokia's revenue actually comes from. While traditional mobile network sales to telecom operators have indeed taken a hit, Nokia's network infrastructure segment, specifically its optical networking, IP routing, and enterprise data center connectivity divisions, is quietly turning into a critical supplier for the massive artificial intelligence infrastructure boom. Big tech hyperscalers are spending hundreds of billions of dollars on data center buildouts, and those data centers require ultra-high-speed optical interconnects and advanced routing solutions to transfer massive data sets without latency bottlenecks. Nokia is no longer just selling cell towers to wireless carriers, they're becoming a core hardware partner for the digital architecture powering modern cloud computing. When you track the recent daily price swings and trading volumes of Nokia stock across platforms like SoFi Invest or Interactive Brokers, a clear pattern emerges. Over the past few quarters, every time a major telecom operator like AT&T or Verizon announces a cut in capital expenditures, Nokia stock takes a temporary hit. Institutional money uses these dips to quietly build positions. We have seen consistent institutional buying under the $3.50 level, creating a firm support floor. The trading volume spikes we saw during the recent quarterly earnings announcement revealed that while top-line revenue in the mobile networks division dropped by double digits year over year, the gross margins actually expanded. That margin expansion was driven by a richer product mix, specifically higher-margin software licenses, patent licensing renewals, and enterprise infrastructure sales. The sector momentum in telecommunications hardware has been brutal over the last 2 years. Macroeconomic pressures, high interest rates, and inventory digestion by major carriers created a severe headwind across the entire industry. Carriers overordered equipment during the supply chain scares of previous years and spent much of the past 18 months digesting that inventory rather than placing new orders. But current order intake data shows that inventory levels at major clients have finally normalized. We're seeing a bottoming process in North American optical network demand, while India and parts of Europe are entering secondary phases of infrastructure modernization. To understand why this inflection point matters for anyone managing their individual brokerage account or using Schwab Intelligent Portfolios for long-term allocation, we have to look closely at what Nokia actually does today versus what people think it does. Headquartered in Espoo, Finland, Nokia operates through 4 primary business segments: mobile networks, network infrastructure, cloud and network services, and Nokia Technologies. The Mobile Networks division provides radio access network hardware, base stations, and radio technology for 2G through 5G systems. This is the legacy business everyone knows, and while it remains a huge revenue driver, it is mature and cyclical. The Network Infrastructure division is where the real structural growth resides. It includes subsea cables, optical networks, fixed networks like fiber to the home, and IP routing technology. The Cloud and Network Services division focuses on software as a service, cloud-native core networks, and network automation tools for enterprise clients. Finally, Nokia Technologies manages the company's vast intellectual property portfolio. Nokia holds over 20,000 patent families, including fundamental patents covering cellular standards like 4G, 5G, and upcoming 6G technologies. This patent portfolio gives Nokia an exceptionally high-margin cash flow stream that functions almost like a technology tax on the entire mobile ecosystem. Smartphone manufacturers, automotive companies building connected vehicles, and consumer electronics brands must license Nokia's patents to operate legally. Recent major cross-licensing agreements signed with giant device makers have locked in billions of dollars in recurring high-margin licensing revenue for years to come. This high-margin cash cushion gives Nokia the balance sheet strength to weather cyclical downturns in telecom spending without risking financial distress or cutting its dividend. If you're looking at your SoFi Active Investing dashboard or evaluating self-investing opportunities on Interactive Brokers' fees and platform features, the underlying financials tell a story of resilience. Nokia maintains a net cash position on its balance sheet, meaning its cash reserves outweigh its total debt liabilities. This pristine balance sheet allows the company to execute share buybacks, pay a stable dividend yield, and invest heavily in research and development without needing to raise high-cost debt in an elevated interest rate environment. Yet the tension between market expectations and operational reality persists. Wall Street continues to value Nokia as a slow-moving cyclical equipment maker tied entirely to carrier capital expenditure budgets. Analysts consistently apply low multiples to the stock because they group it alongside traditional telecom providers rather than high-performance hardware and software infrastructure companies. The expectation is that revenue will remain flat to low single-digit growth for years, capped by the sluggishness of wireless network upgrades. The reality, however, is that the demand profile for bandwidth is growing exponentially. The explosion of high-definition video streaming, edge computing, autonomous systems, and generative AI workloads requires an unprecedented amount of optical transport capacity. Data centers are expanding rapidly outside traditional hubs, requiring long-haul optical connectivity that Nokia specializes in. Furthermore, the push for Open Radio Access Networks, or Open RAN, while initially viewed as a threat to traditional equipment vendors, is an area where Nokia has taken an aggressive leading stance. By making their hardware compatible with open architecture, they're positioning themselves to capture market share from legacy rivals who remain locked in proprietary closed ecosystems. Geopolitical shifts are creating a long-term tailwind for Nokia that many market participants overlook. Governments across North America, Europe, and parts of the Indo-Pacific have enacted strict security mandates banning foreign legacy vendors like Huawei and ZTE from critical national infrastructure. This regulatory exclusion effectively reduces the top-tier global network hardware supplier base into a duopoly in many Western markets between Nokia and Sweden's Ericsson. While this transition takes time due to multi-year deployment contracts, it guarantees Nokia a protected base of market share in high-value developed markets over the next decade. At this point in the analysis, I want to hear directly from you. Drop a comment below right now and let me know how many shares of Nokia stock are you currently holding in your portfolio, or are you waiting for a deeper pullback before starting a position? Type your exact share count or strategy in the comment section. Looking forward into the upcoming quarters, the narrative surrounding Nokia will be defined by several key catalysts and execution metrics. The first major catalyst is the acceleration of enterprise networking sales. If Nokia can prove that its optical and IP routing gear is capturing significant market share in the AI data center build-out, Wall Street will be forced to re-rate the stock from a low multiple telecom vendor to a higher multiple data infrastructure provider. A multiple expansion from 8 or 9 times earnings toward 12 or 15 times earnings would represent a massive repricing in the equity's valuation. The second major variable is the recovery of capital spending among major North American and European telecom operators. As interest rate environments adjust and consumer demand for gigabit fiber and private 5G networks grows, carriers will be forced to resume network capacity upgrades to prevent network congestion. When carrier spending rebounds, Nokia's mobile networks division will experience an operational leverage bounce, driving earnings per share growth above consensus estimates. However, risks remain real and must be factored into any online investment thesis. Supply chain lead times, potential delays in government-subsidized fiber rollout programs, and aggressive price competition from Ericsson could weigh on margins in the short term. Additionally, if macroeconomic weakness causes enterprise clients to pull back on data center expansion plans, Nokia's higher-margin infrastructure segment could see a temporary slowdown in order momentum. When you synthesize the full picture, whether you analyze equities using Robinhood investments, SoFi ETFs, or professional Fidelity trading platform tools, Nokia represents a classic case where popular narrative diverges sharply from underlying corporate trajectory. Market expectations remain anchored